A very good afternoon to all of you. On behalf of the Federation of Indian Export Organizations, I extend a very warm welcome to all of you to our today's important interactive video conference session on export finance solutions and buyers risk management post-pandemic. We have with us today Mr. Ankit Goel, the Senior Vice President, MODIFI, Mr. Navnit, Saurabh, Head of Sales, MODIFI, participants from all across the country in large number. At the outset, I would like to express my sincere thanks to the whole team of MODIFI India for collaborating with FIEO in developing this extremely important session for the Indian exporting community. The session will deliberate upon the numerous issues faced by the Indian exporting community in procuring export finance, as well as discuss how technology-driven solutions are making cross-border business effective and transparent. The session is aimed at empowering SMEs, entrepreneurs, artisans, startups to attune themselves to the relatively new fintech products, which are helping international business in scaling new heights and entering new markets through their contemporary solutions. India, friends, as you know, has emerged as a strong, independent, and functioning, vibrant democracy that is fast growing and has a robust economy. The forecast of Indian economies are extremely encouraging, and economists predict the Indian economy to grow by 7.8% in the financial year 2022-23, while as per the World Bank, the growth in the current year will be around 7.5%, which itself is more than the global average growth. These economic trajectories completely reflect the stupendous and historic growth that India has witnessed in its export sector. India's exports grew by a whopping 45% during 21-22 financial year, from US dollar $291 billion to US dollar $421 billion, highlighting India's manufacturing and export capabilities. This is really a dream come true through concerted and coordinated efforts of all of us. What is remarkable is that growth was exhibited across all sectors by both the employment intensive and sunrise sectors of exports. These figures also reflect that exports have become more inclusive, with participation of craftsmen, artisans, farmers, fishermen, women entrepreneurs, and small businesses. There is no denying the fact that exports are now set to transform the Indian economy significantly, and we have a big target for this financial year to achieve. Friends, securing cross-border finance for exporters has always been complicated and challenging due to various factors involved, like processing time, documentations, eligibility, transparency, etc. Extending timely credit to exporters and importers is essential for the expansion of business and venturing into new and emerging markets. The additional cash flow can attract customers and build profitable long-term relationships with them. With the rise of fintech industry, SMBs exporters are really gaining equal access to markets by affordable yet scalable financial solutions. Friends, I'm sure today's session will immensely help all our participants who have joined us from across the country in large number in understanding the structure of how cross-border financing is done using fintech platforms. For the session, we have with us distinguished regional head of MODIFI, Mr. Ankit Goel, who is a seasoned professional with 25 years of rich experience across different industries and is responsible for the growth of the organization in India, Bangladesh, Pakistan, and the Middle East region. With around 8 years of experience in trade finance, supply chain finance, and working capital management, Mr. Ankit has been helping SMEs to grow their business and manage their working capital and risk better significantly. Mr. Goel is well versed with all aspects of international finance and will share with you his expertise on the subject through a very comprehensive presentation. I would also like to inform that after the presentation from MODIFI, we will open the house for the Q&A session, where you as a participants will get an opportunity to clarify your doubts and ask any questions pertaining to the subject. With these words, I would again like to thank all the dignitaries, speakers, and companies from India and look forward to a meaningful and result-oriented business interactions today. Mr. Ankit is now the floor is open to you. You may proceed with your presentation and address. Before I hand over the floor to Mr. Ankit, just a piece of information for all the participants. Participants are kept on mute to avoid noise. And I would request all the participants to keep their camera open throughout. And during the Q&A session, please just raise your raise hand query on the raise hands query options for any queries, so that we can invite you for your queries with the dignitary. With these words, thank you very much. Mr. Ankit, you may proceed now. Thank you.
Thank you so much, Mr. Jain, for the very warm welcome. And I would also like to take this opportunity for organizing this such a wonderful session for MODIFI and our team. I would also like to tell very briefly about one of our recent colleague who joined us, Mr. Navnit Saurabh. He has joined us as head of sales for India market. I would like him to give a very quick background about himself and macroeconomic environment about India market, and then I'll take it over again and talk specifically about trade finance product. Thank you so much, Mr. Jain. Over to you, Navneet.
So I'll be taking care of India's export performance in 2021 and half of 2022, and which has been phenomenal. Last 18 months, what the Indian export industry has done, whatever the targets we have achieved, whatever the targets government has set, we had over exceeded that particular piece. And this particular slide is the testimony of all those statements wherein for the first time we have crossed $400 billion when it comes to merchandise exports, wherein and we have exceeded even the government's expectation. And the growth, when you see year on year, it was majorly 44%. But the bigger part is, if you even compare it with the pre-COVID era, the growth will be around 32%. So which is the great testimony that the acceptance of Make in India is everywhere. The demand of Make in India products is everywhere. Also, I would like to highlight that if you even compare the growth trajectory or the trajectory of exports with GDP, though the GDP was quite flattening or quite decreasing when it comes to 19, 20 or 21, wherein the export has held that particular fort and the decrease was not that much, which was there evident when it comes to entire overall GDP standpoint. From there, I would like to take you that why this happened, why this entire growth and everything is happening. Everything is happening because the support from the government, the support from all the policies and the compliances standpoint. Our government has played immense role there, coming with the PLI schemes or the trade agreements or the refund of duties and the taxes. Everything is making a conducive environment for the export. They are just helping the ease of business here within Indian ecosystem. And because of that, we are now at a run rate of more than $1 billion day on day. So from there, I would like to come to what we do. So if you see that Indian export is not dependent only on one of the portfolio. Our portfolio from that standpoint is quite diverse. It starts from engineering to petroleum to gemstones, everything. So one commodity, it's not like any other countries where a couple of commodities is driving entire ecosystem. Here in the agro products at one side to petroleum to engineering products, everything is coming together. And this is a beautiful diverse portfolio, right? And this portfolio help us in mitigating the risk or mitigating all those aspects which is not there with the guys who don't have a diverse kind of a portfolio that way. So from what to whom we sell what we sell. So predominantly we sell across the world, but these are the top partners. US always lead the export charters, wherein we might have seen slight dip, but yes, US remains the top exporter from the country, followed by UAE and China. And if you see that in last 25 odd years, whatever the export partners we have, top 6 or top 7 is still constant. That consistency is nothing but the testimony of the fact that the kind of quality you guys, the export community is able to provide to the world, right? Because that's where the repeat business, that's where the demand of that particular product becomes consistent. And then over last few years, we have also moved towards South. and that added Hong Kong, Bangladesh, Singapore in that particular kitty, and they started exporting in a bigger way. So what we share with these particular countries, so like US is a heavy exporter of our pearls and the precious stones or our pharmaceuticals, wherein China is doing more on the iron ore or a cotton side of the things. Bangladesh, on the contrary, is tapping more from our agri products. Netherlands, again, is a petroleum and electronics. Similarly, when you talk to Hong Kong, it's more of a diamond, gold, and other jewelry-related product. So as far as UK or Germany is concerned, it is apparel or a machinery. When it comes to Belgium, it's more of a pearl kind of a demand from here onwards. So moving from here, how the post-pandemic shift in buyer behavior happens. So Ankit, over to you.
Thank you so much, Navnit, for giving a quick background on the Indian economy and the state we are in, which is wonderful. Seems like Indian economy is doing extremely well, and there's enough growth for everybody in the Indian economy. So I would be very happy to share my thoughts on the behavior that we see from the buyer side post-pandemic. So if you could move on to the next slide, Navnit, please. Yeah, so we have structured the whole presentation from this section under three major sections: economic recovery, higher risk and increased bankruptcies, and buyer domination. Yeah, so economic recovery. So if you really look at it, there are three subsections within that. Pre-pandemic, so business was going as usual, everything was sort of hunky-dory, and nobody thought we would be ever hit by pandemic. And nobody ever planned for this disruption what we faced during pandemic. Yeah. And then pandemic hit, supply chain was disrupted completely, everything was on standstill, lockdown in every geography, every country, non-availability of containers, ports are closed, everything is going through the roof. Yeah. Then when we started seeing the pandemic is not really over, but kind of getting over, everybody started getting back to the normal. And then we saw another conflict, which is Russia-Ukraine conflict, geopolitical issues globally, which has again derailed everything globally. Inflation has gone skyrocket. Fed is increasing rate everywhere, which is again kind of derailed the economy everywhere in the world, which is again having a severe impact on every industry, every geography, every manufacturer, every service provider. If we see the bankruptcy cases in the US particularly, it really peaked in Q1 2020, which was basically during pandemic. And then it has started coming down in last few quarters. The filing fell really 16.5% over the last 12 months, period ending March 31, 2022. So which shows basically during pandemic, the bankruptcies in the US really peaked, which was never expected. And then again, when the economy started recovering, the bankruptcies in the US started falling down, which is a positive sign from that point of view. But if we really look at European and Asian bankruptcies, it's not really the same situation, especially in the UK, the bankruptcies are going higher. So if we really see Q1 2020, there were about 3,800 bankruptcies and now gone to about 4,800 in Q4 2021. Versus in Germany, those bankruptcies are going down. Hong Kong also more or less same, and Japan also not significant decrease. So what it shows is US economy recovered slightly better than other economies, and Asian and European economies are still struggling and going through lots of bankruptcy cases. Buyer domination. So what it means is, so we all know that, we don't like it, but it's really a buyer dominated market. So it's really a buyer who decides the price. It's really a buyer who decides what the Incoterm should be. Always the buyer is, of course, asking for, they would like all the exporters and manufacturers to deliver the goods at buyer warehouse so that they pass on the risk of higher freight costs to the exporter. Of course, the buyer wants longer and longer payment terms. Buyer always try to twist the exporters or suppliers and always is in a very, very good dominated situation at this point of time because it's really a buyer dominated market. So there's no storage available to the buyers and they can also cancel the orders whenever they feel they need to. And so it's really a buyer-dominated market at this point of time. How to cope with buyers' behavior changes and extended payment terms. So I think this is really, from my point of view, is the interesting charts which are relevant from my point of view. Please, of course, I look forward to have the very interesting Q&A session with all of you. Again, now we have split the whole how to avoid risk into two broad sections, which is pre-shipment and post-shipment, which are from, again, now my point of view, these are more generic in nature, and we will talk some specific as well. But generally speaking, from pre-shipment point of view, of course, as a supplier, you should collect buyers' information to make sure these are the right companies, to figure out whether these are new entities or these are old existing companies, because you want to make sure you're working with the large and established player as buyers, because end of the day, your money is at stake as exporters or suppliers. Improve your contract details with the buyers. Make sure there are all the appropriate clauses are taken care. Things like, for example, retention of title. So at what stage ownership of the goods is transferred from you to the buyer, things like that. And of course, dispute resolution. In case there's a delay in payment, you should be able to charge penal interest. Of course, again, depending upon who the strong party is in the negotiation, they would be able to, dictate the terms better than other person. Moving on to the third, but now if you could go back, please. Yeah, financing within acceptable limits. You should also be a little careful on how much exposure you take on a particular buyer, so that, as we all say, so you don't go overboard on all the limits of one particular buyer. Always diversify your risk. Also take third-party assistance, which is credit insurance on the buyer, online information, credit check on the buyer, all sorts of information, whatever you can collect from third parties, so that you know exactly who are you dealing with and how much exposure you should take on that particular customer. How should we avoid the risk post-shipment once the goods are out of our door and the goods are now with the buyer or on the way? How should we avoid that risk? Now, documentation is a key in this case. Always make sure the documentation is absolutely right, in line with what is your agreement with the customer. Fix a payment date, in the documents appropriately. What should you do before payment date? Always make sure you do friendly reminders to the buyer. Maybe reminder 1, reminder 2, reminder 3. Make sure buyer knows he or she has to pay the money to you on the due date. Otherwise, there would be interest or penal interest would be kicked in. If there's an overdue payment, always have rigorous follow-up. Ask for personal guarantee or commitment from the buyer. If they exceed the grace period, again, try to have penal interest clauses in there. Also adhere to establish strategies, which are basically try to have maybe down payments, try to make sure you have the relevant instrument in place from the buyers, so that your interest is protected. So that's where I think this is getting interesting now. So what are the potential options available to all the suppliers for risk mitigation and financing? So again, generally speaking, these are the 4 broad categories. What we have: LCs from the buyer, that usually from the supplier perspective is a very much looked after product. Number 2 is trade credit insurance policy, working capital facilities from the banks, and receivable financing from non-banks and fintechs. Now we'll deep dive into each and every product. LCs from the buyer. Yeah, all of us know LCs, letter of credit. Of course, buyers are migrating towards open account. So if I would be buyer or any buyer to that matter, right? So all of those buyers are migrating towards open account, because if they need to issue LCs, they need to block their own limit. And given it's a buyer dominated market, they're always migrating towards open account, and always tell Mr. Supplier, if you want to work with me, I want open account payment terms. Open account means ship the goods out to me. I'll pay you after 30 days, 60 days, 90 days, or even 120 days from the BL date or after delivery, or depends on what the Incoterms are. Yeah, so that means no letter of credit. That's what buyers are trying to do at this point of time. Of course, you need banking lines to discount those LCs if you want to. Again, you need to go to the banks, conventional banks, have different lines in place to get those LCs discount or even accepted. there's a high cost to deal with LCs. So always, so you need to do a lot of tedious paperwork and lots of discrepancies come in. LCs, a letter of credit is a very, very complex document. It seems like, when you have an LC from the buyer, your risk and payment is protected, but it's not really the case. There could be any number of discrepancies which a buyer or buyer's bank can create, and unless you really clear those discrepancies, there's no money. So it's not really a full mitigation. It's a very, very complex product. Trade credit insurance policy. So let's understand very briefly what is credit insurance policy. So like we have life insurance, we have car insurance, or we have even travel insurance. There's something called trade credit insurance. That means in case my buyer does not pay the money on the due date, and I have a legitimate claim against the buyer, I should be able to go back to the credit insurance company and submit a claim, and they're obliged to make payment to me. That is what is called as trade credit insurance. But having said that, does not provide the financing. It means in case buyer does not pay on the due date, we need to submit a claim to the insurance company. Insurance company will evaluate all the documents and whether it's a genuine claim or not. And then if yes, then they will pay the money after the reasonable time period. So it means in case you ship the goods on January 1, due date is, let's say, 120 days, buyer is supposed to pay on 30th of April. Buyer does not pay, we submit a claim to insurance evaluates and maybe pay us in, let's say, June or July timeframe. But you need the money when you ship the goods out, right? Because you need to pay to your supplier, you need to keep manufacturing more goods. So it does not really help you on the financing side. It does help you on the risk mitigation side. Having said that, you do need to manage the policy very clearly, because again, like letter of credit, it's a very complex product. So when you have trade credit insurance, you must manage that document very clearly. There's a huge documentation requirement. You must have your own credit policies, your risk mitigation plan, and also the dispute resolution as well. And there's a very clear documented collection process. You must adhere to that, which is again a very expensive proposition. So it does not really help you with the financing, and it really needs meticulous process planning as well. Working capital facilities from bank, all of us know that, banks, conventional banks, let's say any bank to that matter, provides various banking lines, which could be term loan, which could be overdraft, could be, as we call it, TR, trade receipts, and any other financing facilities that may offer you, and another facility called as invoice discounting, and many other facilities that they offer, right? But again, most of these facilities are backed by collaterals and on your balance sheet, and it's not really kind of taking the risk out from your balance sheet. It does provide you financing, but for that you need to provide collaterals, and it does not really take care of the risk per se. Yep. So it's, from my point of view, again, it's not really an ideal product from risk mitigation and financing point of view. So then let's see what is the ideal product. Let's go to the next slide, Navnit, please. Yep. Receivable financing from non-banks and fintechs. Here I've been put together a comparison between how banks do versus how non-banks or fintech companies provide the financing, and what are the key differentiator between both the parameters. So number one is financial strength. Let's say there's an exporter in India, let's say making t-shirts. Yep. So let's say the revenue is 10, 20, $30 million. Export to buyer, let's say, as an example, Zara. So now when exporter in India goes to a bank, banks looks at exporter's financials, versus when the exporter goes to a non-bank or a fintech, the fintech looks at buyer's financial, which is Zara's financial, which is a game changer from my point of view. When you go to SME companies in India goes to a bank, versus when fintech looks at buyer's financial, which is Zara in this example, it's an absolutely game changer. Yep. Credit risk on buyer. So in case buyer goes bankrupt, bank says, I don't care, I gave the money to you, I need the money back from you. Versus when you go to the fintech or non-bank, in case your buyer goes bankrupt, unfortunately, so fintech and non-banks take the risk and they do not come back to you for the money back. It's called as recourse versus non-recourse from technical point of view. Delay in collection. Again, in case the due date is, let's say, 30th of April, buyer does not pay the money on due date. What usually banks do is they sweep the money out from your current account or whatever bank account you have, so that they settle their overdues. Versus when you work with non-banks, usually that's not the case. They work with you to collect the money from the buyer. So it's not really a sword which is hanging on your neck, that you have to make sure the money gets credited in your account on the due date. So there are few days grace period as well. So you can really kind of work along with the fintech or non-banks to collect the money from your buyer. Fourth point, which is very important from the CFO point of view, balance sheet impact. When you work with a bank, you have receivable from, let's say, again, Zara as an example, and you have payable to the bank. That means it's in your on balance sheet impact. Versus when you work with a non-bank, so the non-bank or fintech buys your receivable. That means you do not have receivable from your buyer and you do not have payable to the fintech. It really helps you to improve your balance sheet immediately. And the last but not least and very, very important point is collaterals. When you work with a bank, there are lots of collaterals you need to give your plant, machinery, house, factory, maybe arm and leg as well to the bank, versus when you work with a fintech, there are no collaterals whatsoever. There's really just a piece of paper which is called as invoice, and based on that, fintech or banks give you the money. It's not lending, they really buy your receivable. So there's no collateral required whatsoever in this case. So from my point of view, this is where it mitigates your risk and also help you on raising the finance as well. Navnit, please. Thank you. How does MODIFI help you? Let's go through that. So what we do is you get paid instantly and we optimize your cash flows with MODIFI. So what does that mean? So let's look at again in detail. So we make you advance payment for every invoice that we work with. So what it means is, let's say you raise an invoice of $100,000 on January 1. On January 2, you have, let's say, $80,000 money in your bank account sitting, which is not a loan. So that means it's really off balance sheet and it's not a receivable, it's not payable to the bank, it's not payable to MODIFI, and your balance sheet also improves. It's really flexible. That means there's no restriction on buyer. You can decide which buyer to work with, which buyer not to work with. You can also decide within the buyer which invoice you want to factor, which invoice you do not want to factor. It's absolutely flexible from that point of view. Non-recourse, as I just pointed out, non-recourse means in case unfortunately your buyer goes bankrupt, MODIFI will not come back to you and ask for money. As long as it's a reasonable and genuine receivable from the buyer, MODIFI will not come back to you asking for money back. Of course, if there's a commercial risk, of course, we do come back to you and ask you the justification for that. Fixed interest rate, what it means is, again, let's say you sold the goods to the buyer on 1st of July. You get money on 2nd of July from MODIFI. There's no foreign exchange fluctuation that you need to wait. Let's say under the current scenario, buyer pays on 30th September. You don't know what would be the exchange rate, and your profitability and your whole calculation can go haywire. Versus when you work with MODIFI on the 2nd of July itself, you get the money in your bank in the same foreign currency which you raise an invoice on. So you don't really need to worry about the foreign exchange as well. It's really quick and easy. As I said, the day you upload the invoice, almost like next day or maybe sometimes same day, you get the money in your bank account. And no collateral, that means we do not take any personal guarantee, no corporate guarantee, no security check, no plant, no machinery, anything of that sort. It's really on the credibility of the buyer, how large the buyer is, where the buyer is based, and what sort of a risk are we talking about from that point of view. So it's not really a conventional banking. So it's really a game changer from my point of view. Navnit, if you go back, yeah. How export factoring works. So just again, a presentation of what I just mentioned. You ship the goods to the buyer and invoice the buyer. Then you upload the invoice on MODIFI's platform. MODIFI pays 80% of the invoice value to you within 48 hours of you upload the invoices on MODIFI's portal. On the due date, buyer pays the money to MODIFI and MODIFI pays the balance 20% invoices to you. As simple as that. Of course, before we start funding, we need to go through the process, which is onboarding process, the KYC, and a little bit of a documentation, which is again not as comprehensive and as tedious as we expect in other products and other products that you work with. So it's really much faster and very simple product that you could work on. Which industries do we work in? We are industry agnostic. We work pretty much every industry. accept precious metal and arms and ammunition. But the key industry that we are currently working in are textile and apparel, chemical, automotive, leather, food, beverages, pharmaceutical, agri commodities, electronics, iron and steel. Pretty much every industry. We even work in the services industries as well. Maybe just to name a few, maybe let's say there's a travel agent who is working with multinational companies overseas. We could look at that. We could look at freight forwarders. We could look at security services company. We could look at BPOs, IT, anything to that matter. So as long as there's an invoice to the right buyer in the right geography, that's what we look at basically. We are serving more than 1,200 buyers and sellers across 40 countries, covering 80% of global trade. So we are present in many, many geographies all over the world, and very, very happy to support SMEs, exporters, importers, manufacturers, traders, suppliers, pretty much every ecosystem within the whole ecosystem of global trade. That's where we're working on. Success story. So again, we have many, many success stories, but just to highlight one, MODIFI provided this is a quote from one of the clients that we work with. They said MODIFI provided us with the leverage to accept business beyond our existing limits, because again, they were going to conventional banks. Banks were asking for more and more collaterals, but again, it was not helping them on the financing side as well as risk mitigation. MODIFI was able to provide them solution, and that really helped them to grow the business substantially. These are the contact details where you could reach out to in case you have any further clarification required or any further information required about MODIFI. And I'm more than happy to take any questions that you may have from me.